What happens when a 3D design giant drops its largest acquisition in history just to learn how the physical world breaks down? Welcome back to our Earnings Unpacked series. Thank you so much for coming to watch the video today.
Yeah, today we are taking a microscope to Autodesk's Q1 fiscal 2027 earnings call. And I mean, we're talking about a massive financial beat, sure, but more importantly, we are looking at this unprecedented pivot into the physical operations of the real world.
Right.
And really what their very distinct approach to artificial intelligence actually means for the future of the entire built environment.
I'm so ready to get into this because, well, the numbers they post are loud. Like for Q1, Autodesk hit revenue of $1.9 billion.
Yeah, which is huge.
It is. That's an 18% reported increase year over year, and their earnings per share landed at $2.99. Both of those numbers didn't just beat Wall Street's expectations, they beat the absolute highest end of Autodesk's own internal guidance.
They did. And to really understand why, we have to look at their new transaction model. That model alone provided about a 3.5% tailwind to their revenue growth this quarter.
Oh, wow. Just from the transaction model.
Exactly. And because of this incredibly strong start out of the gate, management actually raised their full-year fiscal 27 guidance across the board. We're talking revenue, billings, and free cash flow all getting revised upward.
Okay, but as good as those financials are, they're basically the opening act here.
Right. The real story is the M&A.
Yes. The blockbuster announcement of this call is their acquisition of MaintainX. They said it right on the call, this is the largest acquisition in Autodesk's history.
It's massive.
It really is. MaintainX is a mobile-first maintenance and asset operations platform. They're projected to hit over $135 million in annualized recurring revenue, or ARR, in calendar year 2025, and they are growing at over 50%.
Which is wild at that scale. And the strategic context of this is what's truly fascinating. Think about what Autodesk is, right? Historically, they have owned design and make.
Right, like AutoCAD. You design the thing.
Exactly. You use their software to design a skyscraper or, manufacture a complex mechanical part. But once that building is built or that part is shipped, Autodesk's job was largely done.
They just hand it off.
Yeah. But with MaintainX, they are fundamentally expanding their total addressable market by $40 billion.
Yeah.
Because they're aggressively moving into operate.
Meaning they want to track the asset once it's actually living and breathing out in the real world.
Exactly. Their ultimate goal is to create not just static digital twins of real-world assets, but predictive and autonomous ones. And to do that, you need to know exactly how, when, and why things break.
Which brings us to their AI philosophy. This really stood out to me because it feels very different from the standard, we bolted an LLM onto our software pitch you hear from everyone else right now.
Oh, it is entirely different. Autodesk is combining what they call probabilistic AI generation with deterministic engineering validation.
Okay, wait, let's unpack those terms for a second because that sounds like some very heavy engineering jargon. Probabilistic AI, that's essentially the frontier AI models we all know, right?
Yeah, exactly.
The ones that are basically guessing the most likely next word, or I guess in this case, the most likely next pixel or geometric shape.
Precisely. Those models are incredible at dreaming up novel designs quickly. But they don't actually understand gravity. They don't understand material tensile strength or, real-world physics.
Right. They just know what a bridge looks like in a picture.
Exactly. And that is where the deterministic engineering validation comes in. That means using strict physics-based parametric engines to test whatever the AI just hallucinated.
So it's kind of like having a brilliant but entirely reckless artist paired with a rigid, by-the-book structural engineer. Like, the AI can draw a gorgeous sweeping bridge, but how do we know it won't collapse the second a truck drives over it?
We know because Autodesk's validation engines have decades of real-world physics and geometry baked into their code. The frontier AI generates the concept, but then it has to pass through Autodesk's deterministic checks.
For things like geometric integrity and manufacturability.
Right, and constructability. The physics engine acts as the anchor to reality. And here is the real secret sauce.
Okay, what is it?
Every single time the deterministic engine corrects a mistake made by the probabilistic AI, the entire system learns and gets smarter.
Oh, that makes a lot of sense. I mean, you can't fake physics, so the system is constantly self-correcting.
Exactly.
Now, before we get into how the analysts reacted to all of this, we should briefly touch on their internal sales reorganization, because it really sets the stage for a lot of the financial questions later.
Yeah, it's a big shift.
They're basically shifting their partner focus away from just processing easy renewals and forcing them to hunt for new business.
Right. And, as you might expect when you change how salespeople get paid, there is friction. Management noted that this disruption is proceeding exactly as they modeled. Renewals remain strong, but new subscriptions took a calculated hit.
Because the partners are adjusting to the new incentive.
Exactly. And they expect this to gradually normalize over the year.
Taking a short-term hit for long-term health makes sense. Now, in a second, we're going to dive into the analyst Q&A. We're going to group these questions by theme, starting with the sheer sticker shock of this massive acquisition. But before we get to the spicy stuff, if you're finding this breakdown valuable, please click like, share the video, and make sure you subscribe so you don't miss our next analysis.
All right, let's get into the financials and that valuation, because the analysts definitely did not give management a free pass here.
They really didn't. Let's start with Brent Thill from Jefferies, who asked the multi-billion-dollar question. He pointed out that Autodesk is paying 18 times next year's revenue for MaintainX. I mean, 18 times.
It's a huge number.
In a market where software multiples have absolutely collapsed across the board, Brent asked why they were paying such a massive premium and asked for confirmation on whether this was actually their largest deal ever. I gotta admit, when I read that multiple, I thought, is management just spinning this, or is this company actually worth that?
Well, Autodesk didn't flinch. They confirmed right away that, yes, it is their largest deal ever. But to justify that 18x multiple, they pointed to MaintainX's hypergrowth. I mean, growing at over 50% at scale is extremely rare.
Right.
Plus, they have a position as a disruptive market leader. But the real underlying justification is the data. MaintainX provides invaluable real-world operational data that Autodesk desperately needs to fuel that AI foundation we just talked about.
So they're buying the brain fuel, basically.
Exactly. And management stated they expect that multiple to compress rapidly as the business scales, meaning the revenue will catch up to the purchase price quickly.
Got it. And Jason Celino from KeyBank Capital Markets kind of piled onto this financial thread. He wanted to know exactly who the core user of MaintainX is, but more importantly, he asked a critical margin question.
Right. The 2029 framework.
Exactly. Can Autodesk absorb the massive margin dilution of this expensive acquisition without breaking the fiscal year 2029 operating margin framework they've been promising to investors?
So management clarified that the core user of MaintainX is the asset owner. This is the person whose entire job relies on tracking uptime. They need to know exactly when a factory machine is going down for maintenance before it actually breaks.
Okay, that makes sense. But what about the margins?
For the margins, Autodesk was incredibly firm. They confirmed they will absorb the margin dilution from this deal while staying entirely true to their fiscal 2029 goals. They plan to use the underlying operating leverage of their core, highly profitable design business to fund the integration.
Basically pitting for the new shiny thing with their steady cash cow.
Precisely.
Okay, sticking with the complex financials, Taylor McGinnis from UBS wanted to unpack the delta between their billings growth and their revenue growth. She specifically asked about the impact of price realization on unbilled deferred revenue, noting that their remaining performance obligations, or RPO, only grew by 9%.
Yeah, that's a mouthful of accounting terms.
It really is. Can you explain RPO and unbilled deferred revenue to me like I'm not a CPA? Why are their contract durations suddenly dropping?
I can absolutely translate that. So RPO is essentially money that customers have contracted to pay Autodesk in the future, but Autodesk hasn't provided the service yet, so they can't recognize it as revenue today.
Okay, like pre-ordering a game almost.
Sort of, yeah. And what's happening here is a strategic trade-off. Autodesk made an intentional decision to reduce the heavy discounts they usually offer on multi-year contracts.
Oh, so because a 3-year deal is suddenly less discounted, customers are looking at it and saying, forget it, I'll just sign a 1-year deal instead.
Exactly. And when a customer signs a 1-year deal instead of a 3-year deal, your RPO, that future promised money, drops in the near term. It weighs on the optics of the quarter.
But it's actually better for them in the long run.
Right. Autodesk emphasized this is a highly profitable long-term economic decision. They are trading the vanity metric of long-term contract duration for much better, more profitable long-term pricing power.
Wow, okay. That actually perfectly sets up Alexei Gogolev from JP Morgan, who followed up on that exact dynamic.
Yeah.
He asked what is currently driving a customer's decision between multi-year and annual contracts, and then he shifted gears to ask for a near-term roadmap for their AI tools, specifically the Autodesk Assistant.
Yeah, so on the contracts, management reiterated what we just discussed. It's driven by that reduced discounting strategy, combined with a specific mix of customers up for renewal.
Like the really big enterprise clients.
Yeah, massive enterprise clients still naturally skew toward 3-year agreements, just because of how their procurement works. But on the AI roadmap, they tease a very compelling upcoming feature called the Building Layout Explorer Informa.
Oh, what does that do?
It uses their foundation models to dynamically generate and explore building layouts while actively checking them against physical, real-world constraints. And they promised a flood of new AI announcements at their upcoming Autodesk University conference.
That sounds incredible. We also had Ken Wong from Oppenheimer asking a highly specific financial question. He wanted to know if the slight change to their constant currency billings guidance was just a rounding error, and he asked if they felt any course corrections were needed for the sales changes based on the friction they've seen.
Management gave very straightforward answers here. Yes, the billings adjustment was largely a rounding dynamic, representing no fundamental shift in the business.
So nothing to worry about there.
Right. And absolute no course correction is needed for the sales reorganization. The pipeline disruption they were experiencing right now was fully modeled and expected.
They knew it was coming. Rounding out the financial theme, Michael Turin from Wells Fargo asked for an update on the evolution of their pricing model. He wanted to know how confident they are in layering a company like MaintainX into that system. And this brings up the whole subscription versus consumption debate. How does that actually change the way an asset owner pays for the software?
It changes everything, honestly. A subscription's a flat fee, right? You pay $100 a month whether you use the software once or 1,000 times.
Standard SaaS model.
Yeah. But a consumption model is like your electricity bill. You pay for exactly how much compute power or AI generation you use.
Oh, I see.
Autodesk expressed very high confidence here, explaining that they've spent years building mature back-end systems capable of handling a highly complex mixed environment of both models. MaintainX is currently a flat subscription, but as it adds more heavy AI capabilities, it will naturally transition toward a consumption model.
Making it a perfect fit for the infrastructure Autodesk has already built. That makes total sense. Okay, let's pivot to our second major theme from the Q&A, which is the actual product strategy, the AI integration, and how they plan to take all this to market.
Yeah, this is where it gets really interesting.
Definitely. Saket Kalia from Barclays kicked this off by asking for more color on MaintainX. He specifically asked how Autodesk's past experience expanding into the construction sector is informing this massive new move into downstream operations.
If we connect this to the bigger picture, Autodesk views this operations push as the final puzzle piece to converge, design, make, and operate. They were running the exact same playbook they successfully used for construction.
Wait, how much did they spend on construction again?
Think about the math here. 5 years ago, Autodesk spent $1.8 billion acquiring construction platforms. Some people scoffed at the price tag then.
Yeah, that's a lot.
But today, those specific assets generate nearly $600 million in ARR and are growing at 20%.
Wow, so it paid off.
Massive payoff. And to ensure this new operations bet follows that same profitable trajectory, they're bringing in veteran leaders, like Stephen Hooper, the guy who successfully scaled Fusion to run this new Operations Solutions group.
It's a proven playbook on paper, sure, but construction and manufacturing are notoriously fragmented. Which brings us to Jave Leishauer from Griffin Securities.
Right, he had a great point.
He asked how MaintainX fits technically into the architecture, engineering, and manufacturing data models. And he brought up that a lot of major customers are just building their own homegrown tools right now. So how does Autodesk's platform compete with a custom tool built by the client themselves?
Autodesk's response was brilliant because they actually encourage customers to build homegrown tools.
Jay, really? They want them to build their own?
Yeah. But they pointed out a hard, technical truth about the future of agentic AI. You see, agentic AI doesn't just answer questions, it takes actions. And to take an action in a complex supply chain, the AI requires massive cross-industry data and context. No single customer, no matter how massive their homegrown tool is, possesses enough aggregate data to fully understand the scope of a multi-company project.
Oh, I see, because they only have their own data.
Exactly. Autodesk's overarching platform is necessary to orchestrate that entire ecosystem. MaintainX simply adds incredibly granular, real-world asset performance data to that broader pool.
That is fascinating. Speaking of execution, Adam Borg at Stifel asked about the degree of disruption from those go-to-market sales changes. And he specifically asked what dynamics were driving the 16 to 17% growth they saw in the EMEA region, so Europe, the Middle East, and Africa.
On the sales disruption, Autodesk again confirmed the expected friction. New business growth was weak, while renewals stayed strong as partners adjust.
Right. And what about EMEA?
Regarding EMEA, that 16 to 17% growth was driven by timing dynamics.
Right.
They had strong upfront revenue last quarter, which was the peak of the new transaction model tailwind in Europe. Also, local labor laws and strict consultation requirements in Europe mean the sales reorganization is just taking a bit longer to roll out there compared to the U.S.
Ah, bureaucracy slowing things down a bit. That tracks. So Joe Vruwink from Baird asked a really interesting strategic question next. He wanted to know if AI is actually acting as a customer acquisition channel, pulling in new users. He also asked how Autodesk's approach to downstream operations with MaintainX differs from older competitors who have tried, and largely failed, to do this.
The answer to the AI question was a definitive yes. AI meets non-technical customers where they are. It makes complex tools way more accessible and pulls them right into the Autodesk ecosystem.
Because it's easier to use.
Exactly. And as for the competitors, the answer was really sharp. Older operations software often relied heavily on integrating with other massive platforms like Salesforce and required intense, expensive customization just to work.
Which nobody wants to deal with.
Right. MaintainX, on the other hand, is a heterogeneous, standalone solution. It connects the entire end-to-end digital twin process directly to the person holding a mobile phone on the factory floor without needing a massive IT deployment.
Which is just huge for adoption. If the guy on the floor can just use his phone, he's going to use it.
Precisely.
Now, Joshua Tilton from Wolf Research noticed a tactical move on their e-store. He saw that Autodesk Build was recently rebranded to Forma Build with lower pricing and asked about the strategy there. Then he zoomed out and asked the big macro question. Why is right now the right time to pull the trigger on such massive M&A? Why drop prices for general contractors on one hand while spending billions on the other?
Yeah, it looks contradictory on the surface. But on the pricing side, that lower price tier is specifically called Forma Build Essentials. It's a smaller, highly targeted version designed to aggressively capture mid-sized general contractors who simply couldn't afford the premium enterprise tiers.
So it's purely about market share.
Exactly, getting them into the ecosystem early. And as for the M&A timing, Autodesk insisted they are highly disciplined. They're making this massive move for MaintainX right now because expanding their real-world data layer is the absolute critical path for winning the future of agentic AI.
If they wait, someone else gets the data.
Exactly. If they wait, someone else captures it, and they lose the advantage.
But capturing that data is complicated, which Tyler Radke from Citi zeroed in on. He pivoted to talk about the largest clients. He asked what the appetite is among their large enterprise business agreement, or EBA, customers, to actually let Autodesk use their proprietary data to train these AI models. I mean, are giant corporations really going to let Autodesk train AI on their top-secret proprietary blueprints?
It's a great question, and it entirely relies on transparency and choice. Autodesk stated clearly that customers have the absolute option to opt out of data sharing.
Okay, so they can say no.
Yes. However, the surprising reality is that many of these massive enterprise clients are actually eager to participate.
Wait, really? Why?
Because they desperately want the exact automations that Autodesk is building. They know that for the AI models to actually be useful for their specific factory or their specific supply chain, the model needs to be trained on their specific industry data.
Ah, so they want the magic trick, so they have to show the magician their cards.
That's a perfect way to put it, yeah.
Wow. Finally, Clark Jeffries from Piper Sandler wrapped up the Q&A. He asked when MaintainX will actually see that consumption model roll out, and if Autodesk will expand their go-to-market motion specifically for owner-operator.
So management clarified that it is still too early for MaintainX to fully implement a consumption model right now. They're focused on scaling the user base first.
Get the users first, change the billing later.
Exactly. However, regarding the go-to-market strategy, Autodesk absolutely plans to build out a robust, dedicated sales machinery to target owner-operators. They were going to start by focusing heavily on manufacturing, and eventually they plan to expand that aggressive push into commercial buildings and critical infrastructure.
Wow, okay. That is just a staggering amount of strategic maneuvering extracted from a single quarter's call.
It really is. If we step back and kind of synthesize the main themes from this entire presentation and the Q&A, Q1 was a massive financial success that fundamentally gave Autodesk the leverage, the capital, and the confidence to make their biggest bet ever.
Yeah, that MaintainX acquisition.
Right. And by buying MaintainX, they aren't just buying another piece of software to sell to facility managers. They are buying the real-world data needed to make their AI engines undeniably accurate.
It's the deterministic stuff we talked about.
Exactly. They're closing the loop between how things are designed on a screen and how they actually survive, operate, and eventually break down in the physical world.
It's the difference between drawing a complex machine and knowing exactly which Tuesday its gears are going to grind to a halt.
Exactly. And, this raises an important question for you to think about as we wrap up.
Oh, I like where this is going.
If Autodesk successfully captures the data of how every physical asset degrades, requires maintenance, and breaks in the real world, do they eventually stop being just a software design company and become the ultimate predictive oracle for the entire physical economy?
That is a wild thought to leave on. Thank you so much for watching. If you enjoyed this breakdown and found it valuable, please click like, share the video with your network, subscribe to the channel, and stay tuned for our upcoming content. See you next time.